What's up, owner investor? In this video, we are going to see how Basic Fit makes money. So it's going to be similar drill to the previous videos in this section, but I'm going to, again, throw a little curveball at you. And instead of picking out the key slides or paragraphs from the investor materials, I'm just going to give you the entire document. But luckily, Basic Fit is not as intense as Spotify and like really long and challenging. Not long and challenging, but like the Spotify annual report is just there's a ton of detail thrown at you, and it's not presented in in slides. Whereas Basic Fit, they present their information in a much more digestible way. So I'm just going to give you the entire slide deck, the entire presentation, and like a pretty short report that accompanies it. They're both 17 pages long. You don't necessarily have to read every word, but the goal is to just create that similar kind of walk, right? Like this thing that we've been doing so far, right? Like from revenue, how do you want to break up revenue? How do you want to break up the expenses and get to diluted earnings per share? So a couple things with Basic Fit that might be a little, not might, that I know are going to be confusing because I find them confusing oftentimes, which is, so there's a couple things here. One is that Basic Fit doesn't really tell you what the total share count is. So you kind of have to calculate it yourself. Right, so they tell you the profit loss for the year, and then they tell you the basic and diluted earnings per share, and it looks like the basic and the diluted numbers are the same. So because remember, earnings per share equals like the profit for the period minus any kind of preferred dividends, which Basic Fit is not paying any preferred dividends because it doesn't have any preferred stock outstanding. So it's just the profit divided by the shares outstanding, and they don't really tell you the shares outstanding, but you can back into it by just doing a little algebra here, right? Taking the profit and dividing by the loss per share. So that's one thing. The other thing is the numbers are a little bit different because this is a European company, and like the disclosures are a little different. It's not again, this is why like memorizing definitions is not the best way to go about these things, because each company stuff changes in terms of how they define different terms and how they adjust for different non-recurring or like temporary items. So Basic Fit is a gym, right? So the thing is, because of COVID, and we can see this here, right? Like COVID basically like crushed the business temporarily, and the business is still kind of digging itself out of kind of the recovery from the pandemic and a lot of location closures because the rules in Europe have been stricter kind of coming out of the pandemic. And so that messes with the numbers, right? Like you can see underlying EBITDA, and I'm going to define this in a minute here, got crushed, and then now it's kind of on its way back up. So there's a couple things here, which is one, the concept of EBITDA, which stands for, and again, like I don't want to like get into like too many definitions here because like the definitions you can just kind of look up. It stands for earnings before interest, taxes, depreciation, and amortization. There's a lot of controversy over this metric. Like Warren Buffett and Charlie Munger hate this metric because it's just like adding back all the costs of running the business, right? And it's just too close to revenue to be any real kind of measure of true profitability. But where it's helpful is kind of to be able to compare one business to another, and two businesses that might spend a different percentage of revenue on depreciation, and being able to compare and like creating a standard across multiple businesses in the same industry that might have different capital structures, like where one has borrowed a ton of money and another one hasn't, but we kind of just want to evaluate like before leverage how the business is doing, right? So it helps to kind of compare across different industries, but we're not really going to be using EBITDA as our measure of profitability, right? Like we're going to use earnings per share, like profit per share, and like normalized profit per share. But where this is helpful is that the management team is kind of taken a crack at kind of normalizing the expenses for us from COVID, right? And we can see that here in the report, right? So we can see what the reported EBITDA is, and then we can see what the underlying EBITDA is right here, actually, sorry. So reported EBITDA and then underlying EBITDA, right? And what they're basically doing is subtracting out the rent costs and adding back a couple like exceptional items, which, you know, was a big number in 2021. So this is like another area of controversy where a lot of management teams will play games with the numbers, and you know, they just add back like a ton of expenses and make it seem like their business is more profitable than it actually is. So that's like another task of us investors, is we have to like be able to call out management teams on their bullshit and say like, okay, well, you added all this stuff back, but it's not like this is temporary. This is actually like an ongoing cost that your business is going to face, right? Like we see that a lot with restructuring costs. Like IBM, for example, it's like constantly in this like restructuring phase, you know, for the past like 10, 20 years. GE is another really great example. I mean, Jack Welch even admitted to kind of like manipulating the earnings numbers to, you know, meet Wall Street estimates, right? So this is where things get a little bit tricky when like the accounting, when the numbers can lie to you, where you have to kind of dig in a little bit deeper and find the truth. So, and another kind of complication with Basic Fit is this change in accounting rule that happened a couple years ago with how rent is treated by the accountants. You know, 5 years ago, what would happen is if a company had, you know, retail stores and they were paying rent, meaning instead of owning the stores, then that was just kind of included in operating expenses, right? No big deal. But the problem is like accountants, when they saw that, their point is that, hey, actually those rent costs, that's actually kind of like debt, right? Because you've signed like a 5-year, 10-year lease for all these stores, and you have to meet those fixed obligations regardless of how much revenue your business puts in, right? Like employee expenses are different because you can just fire employees, right? Like if a store or a location or warehouse is underperforming, you can just fire the employees and like close down the location. But the problem is with rent, you've signed a lease, right? That says, hey, I'm going to pay you rent for the next 10 years to your landlord. And so you can't just walk away from your lease, right? So now that actually is more like debt. And so the accountants have forced companies to treat leases like debt. And what that does is it creates a huge mess in the financial statements, because now that rent expense is broken up into like depreciation and interest. And then they create this asset that goes onto the balance sheet, which is like the value of the properties that you rent. And then it creates this lease liability. And there's like, I could spend like an hour just talking about just this idea. But what a lot of companies do is they basically say, okay, screw all these accounting rules. We're going to just show you what the numbers would look like if this accounting nonsense rule, didn't happen. So that's what they're doing here with the underlying, like the underlying EBITDA number, And the difference between club EBITDA and underlying EBITDA is there's overhead costs that sit above all the locations, right? Like the cost of like the regional managers. If you ever watch The Office, Jan is like a regional manager, but Michael Scott is, a branch manager, right? So Michael's salary would be like a location level expense, but then Jan's salary would be like an over like a regional overhead expense that sits above the clubs. And also the cost, like the salaries and the compensation of the CEOs, like the rent of like the corporate headquarters building, all of that stuff sits above the locations, right? This isn't really an issue for a company like Spotify where they don't have locations. It's just like they just have different off. There's no like overhead versus like store level economics. But for businesses that have stores, this is part of how to like break up the business, right? Is store level expenses and then expenses that sit above the stores. So it's kind of a long-winded way of explaining that. So the difference between club EBITDA and underlying club EBITDA and underlying EBITDA is that we want to use the underlying EBITDA number because this subtracts out roughly 113 million euros of overhead that sits above the clubs, right? As investors, like that's a real expense that's going in to the business. But the reason they break it up like that is because that's like another number that as the number of clubs expands, right, as that grows, the overhead that sits above the clubs, that number won't grow as fast, right? So we can break that up to have like a better, more accurate picture of how, as revenues grow, how that'll trickle down to earnings over time, because you'll get leverage on those fixed costs, meaning when those costs, the overhead costs stay fixed and revenue grows, your earnings will grow faster than revenue, right? Like that Airbnb example where, like I think it was like revenue grew, in our made up example, it grew at like 23% or something. And then profits grew at like 96% because we kept all that stuff, the operating costs fixed. So that's why all that matters. The numbers are a little bit messy, but I've kind of given you some clues here as to like what to focus on. And I do want to kind of toss you to the deep end a little bit and just give you like the full report. And I think with Basic Fit, you guys should be able to handle it. If not, we always have the Q&A sessions, and we also have the comment section to clarify. This stuff, like you're probably not going to get it. Like it took me a while to like understand this stuff. So don't be frustrated if you don't get it on the first crack. It is a lot of information, and I'm trying to simplify it as much as I can, but there's always going to be little corner cases where I haven't provided enough clarity, where I can supplement that for you in the calls and in the comment section. So I'll see you in, and this might even end up taking you like 15 to 20 minutes. So I'll see you once you have that set up for yourself. Okay, so let me crack open my Basic Fit model. Cool. So open up another tab. We'll call this normalize DPS. And okay, so I'm gonna start off with, and this is a great slide, right? Like this kind of just quick snapshot of the business. So I'm gonna start with the number of clubs. So I'll just call this, I'll go back, because the financial statements only go back 2 years, so I'll just go back 2 years to 2020, 2021, 2022. Clubs. And then I want to do members per club. Members, and then revenue per member, revenue Okay, now we have to make a decision on how we want to break up these expenses. So see if there's like a more detailed breakdown. So see, the problem now is all of these adjustments, right? So it's a simplifying assumption, but I'm just gonna run it like this. So I'm gonna call this cash OpEx, and this will be underlying club EBITDA, overhead. And again, there's like lots of different ways to break this up. So it's not like, there's no like one right answer. It's just kind of whatever makes sense. And plenty of smart people can disagree on how to break up a business. So okay, and then I'm gonna do overhead, and then this will just be underlying EBITDA, and then I'm gonna have depreciation and amortization, and this will get me operating income, or EBIT, same thing. And then now, remember, basic fit has debt, so we want to make sure that we include that, right? And they mentioned the debt right here. Net debt of $694 million. So net debt, interest rate, interest expense, and then we'll call this profit before taxes. And then taxes, tax rate. Net income, shares outstanding, ABS. Okay, so all right, so 2021, there's 1,015 clubs, and 1,200. Color this blue as usual. Comma separated values, cool. And then members. So this is in thousands. I'm just going to enter the number in millions. 2.22, 3.352, 3.352, cool. This is also hard-coded. Get a number. Have like one decimal out. Okay. So now, because there's a difference in units, you know, I'm going to multiply this by 10 to the 6th divided by that. So they had about 2,200 members per club, and then 2,700, right? Again, this is the kind of the recovery from the pandemic being reflected in the numbers. Throw a little bottom border on that. Okay, and then revenue, 341 million euros, going up to 795. Okay, so this is an annual number, right? So the average member spends about Wow, that's a big jump, right? 154 to 237. I think that was driven based on, I think it was also just club closures, and also the premium membership penetration rate has increased quite a bit. It's kind of flat for all of 2020. Yeah, I think it was more driven by just more months out of the year, because I don't think they charged members for months where they were closed. But again, that's something we'll have to see in the earnings call, why that jumped up so much. Okay, so underlying club EBITDA, 32 million to 204. Also a hard code. And then the overhead. Okay, so the overhead is going to be an implied number. Oh, actually, I think I just used the wrong number. So I just used the underlying EBITDA number here. So we actually want this to go here. And then this is the underlying club EBITDA, which is disclosed right here. 93.6 going up to 316.4. And we can see there's about 112 million of overhead that sits above the clubs. Okay, depreciation and amortization. This is another kind of tricky one because of that annoying change in accounting rules. Yeah, there's a lot of people in the investment community that hate this rule with a passion. Okay, yeah, see, now they have broken out the depreciation into these three components, right? We don't care about this depreciation of right-of-use assets because that number, like this rent number, this 187, because of like accounting gimmickry, has been broken up into like lease interest and lease depreciation. Don't ask me like how they calculate those things. I mean, we can do a separate video on that. It's like there's just a ton of like unnecessary complexity, but this rent number, this 187.5, has basically been broken up into depreciation and lease costs. But because we are using this underlying number that the management team says, hey, fuck all this accounting nonsense, we're just going to give it to you the way it was before the accounting rule changed. We've already included that, right? Which is why the underlying club EBITDA, it's lower than this because it's already subtracting out this rent number, okay? So what we want to do is actually just include the depreciation and amortization. That's like kind of the core depreciation. And if you're not familiar with what depreciation is, I'm sorry if I haven't defined this. Depreciation is basically when Basic Fit opens a new location, there's a bunch of upfront capital investment that has to be spent, right? In terms of the fixtures, in terms of the equipment that they have to buy, like the cardio, like the treadmills, the dumbbells, the like fixtures, because not all the locations have been like fully renovated to be a gym when they signed the lease. So Basic Fit has to invest all this upfront capital expenditures in fixing up the location and putting all the equipment and stuff in. But the benefits of that expense is realized by Basic Fit over many years, right? So this is kind of one area where the accounting does make sense. Before they required like this additional thing where they had to capitalize the leases. But what depreciation does is basically says, okay, let's say you spent $1 million to fix up like this location and load it up with all the equipment. And let's say all of that stuff has a useful life of like 10 years, then what you should actually do, instead of showing $1 million of expenses in year one and then $0 of expenses from years 2 through 10, what you do is you spread that $1 million across those 10 years, right? And that gives kind of a better picture of what the kind of like the profitability per year of the business is, right? Because the reality is that there's maintenance costs that goes into the business, right? Like refreshing the equipment. Maybe the equipment lasts for 10 years, but there's like repairs that happen once in a while, right? Like when you buy a car, for example, there's like repairs that happen, but it doesn't mean that like the car's useful life might be like 50 years or 20 years or whatever it is, but there's maintenance costs every year, right? So it's not like the car has zero, like you spend a certain amount today and then zero costs forever. There's ongoing maintenance costs, and that's referred to as maintenance CapEx. And usually that's something that'll show up in the cash flow statement, which again, we're going to cover in a couple of videos, in a couple sections. But usually depreciation and maintenance CapEx should be approximately the same. And then there's growth capital expenditures, which the business spends in new locations, to add new locations, to add more equipment, and or like if they want to invest in like technology, sometimes that'll be capitalized and thrown into the cash flow statement and then spread out over like the useful life, and then that spread out number, that's what shows up in the income statement. So again, like this is like we're getting into like really like nitty-gritty details about accounting, just please like post something in the comment section if this is confusing, and I'll clarify kind of as we go along. But we just want to include these two things, right? So in 2021 it was minus 125.3 minus 10.8. And then in 2022 is minus 151.1 minus 8.7. Cool. So you can see like 2021 was a rough year for the business. Okay, and then net debt is area 694 million. Okay, so another kind of layer of complexity is that I think Basic Fit reports every 6 months. So they have a new report that's come out, I'm pretty sure. Let me just financial results. Yeah, so they have like a Q1 trading update where they'll kind of give you I don't think they break out the amount of debt the business has. No, they don't really tell you the debt. Okay, so this is I think this is a pretty good number to work with, the 694. Okay, what's the interest expense? So again, this interest expense number, this is going to be another messy number, and we have the accountants to blame for this once again. But luckily Basic Fit kind of breaks out, because like there's the lease interest versus the actual interest on the debt. So we don't want to deal with the lease interest because we've already subtracted out rent. So this is 23.8. And 26.1. Oops. and we can just kind of calculate an implied effective kind of interest rate, 4%. That's pretty sweet. But I bet if they tried to borrow today, that interest rate would be much higher. So another kind of, and I'm throwing like a lot of layers of complexity here as we go on, but this is just the nature of the beast. So if it's like the same thing with mortgages, right? Like if you signed a 30-year fixed-year mortgage 5 years ago when interest rates were way lower, now interest rates are a lot higher, but you locked in that old interest rate, right? So in your mortgage, you're paying a much lower interest rate than what it would actually be market today. So same deal applies for companies. Basic Fit borrowed when interest rates were low, and so now 4% is too low of an interest rate for a company like Basic Fit to borrow. And so one thing to kind of look at, and again, it's not really something we're gonna deal with now, but it's just something to kind of be aware of in the back of our mind, is the maturity on the debt. Like when this debt comes due, whenever it comes due, it's going to have to be refinanced, and it might get refinanced at a much higher rate, right? So that's something that I think they'll have that. I don't know if they included that in this investor presentation. But usually companies will tell you, hey, like this is when our debt matures. And that's for companies, especially for companies that are like close to distressed. That's something that you really want to pay attention to. Because that's usually like a trigger event for potentially for bankruptcy if you're looking at a distressed company. But Basic Fit, how do we know it's not distressed? Well, for one, they're able to cover their interest expense. This is pretty tight, right? Like a coverage of 1.7x, right? But again, this is not like a normalized year for the business. And how do I know that, right? So we can take this underlying EBITDA and underlying club EBITDA and divide by the number of clubs, and we get like 263,000. And normally one of their locations, once it matures, it does like 431,000, right, of club EBITDA. So this number is like, as the clubs mature, this number will get higher, right? So if they just stopped adding new locations, this number would go up a lot, and then their interest coverage would also go up a lot. So I wouldn't consider Basic Fit like a company that's in financial distress based on those metrics that I just looked at. But again, like you can always disagree with me and come to your own conclusion based on your own research. Again, like we're gonna ignore the whole like tax loss carry forward and just keep it simple. Okay, the shares outstanding. Where did they? Okay, it was in the report, right? Yeah, another thing, if you do happen to look at a distressed company, this is something to be cognizant of, which is like when you borrow money, it comes with terms, right? Like covenants. this is getting probably into like too much detail that we don't need to get into, but just like a little tidbit that I'll flag. And this is like what I used to look at a lot back in the the restructuring days. But their covenant threshold is 3.5 times net debt to adjusted EBITDA, and they're at 2.9 times. And this adjusted EBITDA is like, again, like this is why you can't memorize definitions, because in every like credit document in every company, they'll define EBITDA in like different ways, and there'll be different things, expenses that are allowed to be added back. So that it varies from one company to another. So the way that they've calculated it, it stood at 2.9x, and the covenant threshold is 3.5. And even if you break the covenant, it's not necessarily the end of the world. You just kind of go back and like renegotiate with the creditors. And if you're like really in trouble and you can't pay interest, then there's a reasonable chance that the company will have to file for bankruptcy. But we're not really anywhere close to that, right? So including undrawn facilities, which is just like, think of those as just like credit cards for a business. The company had access to like 143 million of cash and cash equivalents, right? So 143 million, and they're profitable, right? So I wouldn't really be worried about distress based on that. But remember, the facts can change, right? So like we could have like another wave or something, like some new strain that comes out, and the business is forced to like close a bunch of their locations for like another year, and then like things change once again, right? So I'm just trying to find the dilute. Here we go. Okay, so in 2021, it was minus 150.048 divided by 2.34. I'll make them both negative. Okay, so 64 million minus 3.67 divided by minus 0.06. That's strange. Oh, the share count changed. But I thought the share count increased. Minus 150.048 divided by negative 2.34. So this is something I want to check. I think with Basic Fit, I just want to check another source for the share count. I think it's in here, the shareholder. Okay, so for some reason they did not include some shares in their calculation, but like different businesses, like because this is not a U.S. companies that are listed on U.S. exchanges, they'll disclose the share count on, on the first page of their annual report, their 10K or their 20F. But international companies, they have like their own places where they disclose the share count. So Basic Fit, kind of annoying. They put it on their website instead of like the actual filings. So Basic Fit has 66 million, but for some reason this thing goes 61, and that is kind of a material difference. So I'm just going to run with like this 66 million number. And I know that this wasn't included in the case docs. So again, like it's not about getting to the right answer. It's just, we're just kind of still like learning this stuff. So wouldn't stress too much about that. But yeah, I apologize if it's confusing. Okay, cool. So this is kind of the walk to normalize DPS. The key thing to remember here with basic fit is kind of this revenue per member number, right? It was depressed because of COVID, and then it's kind of shot back up. Sorry, right here, revenue per member, and the members per club. But if you really want to just kind of really simplify this, it was really the underlying club EBITDA divided by right. So here I'll just multiply it by 1,000. So it's like we're comparing apples to apples. So $264,000 of like implied club level EBITDA per club, and their mature locations, they do. And also another thing is like I'm dividing by the number of clubs. Like it would be more accurate to divide by average clubs, but we can do that kind of in the forecast. But yeah, like they have this at 431 for mature clubs, because like clubs take some time to ramp up to kind of a more steady state number of members and like revenue per member. And so this is kind of like embedded growth that already exists in the business, that if they just shut off all growth, like the business would just like gush cash flow because of this quirk, right? And this is something that is really important to understand. Again, like if we just looked at the EPS definition, we wouldn't know all these things, right? And so let's just go kind of check what the analysts are saying on ticker.com. BFit, basic fit, NV, yep, this is it. Okay, so they have revenue growth kind of coming down to like 34. And remember, this is the 133% because it's coming off of a low base, right, from COVID. 30s, okay. All this EBITDA stuff is going to be messed up because we're using like underlying EBITDA and not the reported EBITDA, and ticker.com is going to be using reported EBITDA. So lots of numbers flying around. But you know what? Like that's what creates opportunities, right? Like that's why sometimes like stocks get mispriced, because people just look at this like Yahoo Finance numbers and they don't actually dig any deeper. And that's where the opportunity lies for people like us, that kind of go in and actually do the work, right? So yeah, I mean, they're forecasting revenues to keep growing, EBITDA to keep growing at a pretty rapid rate, and then for some reason it's like falling off here, but you notice that it's only like one estimate and it's like 6 estimates here, right? So that's what's causing that. It's like another thing with investing is just numbers can lie, right? Like numbers can sing any song that like whoever prepares them wants it to sing. And so we gotta be able to kind of dig in a little bit deeper and say, okay, like where is that number coming from? What does that number mean? Does that make sense? What adjustments do I need to make to kind of get like a more accurate picture of what's happening? Right, like whenever you read like news articles, they'll just like throw out numbers, or like debates, like presidential debates. They'll just say like, oh, XYZ study says like 4% of whatever thinks that. And unfortunately, like if you want to be a decent investor, that's just not enough depth. You got to like go in a little, like a couple levels deeper and see where those numbers coming from. What do they mean? So just understanding like this stuff, like hopefully this, if you're not used to it, I know it can seem somewhat challenging, but I hope it makes you a better thinker in like other aspects of your life as well. Because I know it certainly has for me, right? Like as I said, I hated school and like physics and biology and stuff, but investing has really taught me how to become a better thinker. Why? Because I enjoy doing it, right? And this is like a really going off on a tangent here, but people use like the ACT or the SAT as a measure of like intelligence, and to some extent, I think that's true. But to another extent, I think it's misrepresented, right? Because no one likes the actual subject matter that's being like, who wants to read about the mating patterns of like some random tribe of elephants, right? Which is what the reading excerpts are in these standardized tests, right? If you tested people on something that they're actually interested in, like, I don't know, like video games or something, you would actually see that people actually have significantly higher aptitude. And so using this kind of applied skill of investing to become a better thinker, that's kind of has been my trajectory. Like I used to be, like I wasn't a very good thinker before I started getting into investing. And investing has not only helped me, make money, got me a job, it's also just made me a better thinker because I have to, I'm forced to kind of go deeper on what these numbers mean and start to think from first principles instead of just relying on some random article, right? I still leverage those other articles to help me be more efficient with my research, but I'm going to go like one level deeper to see like what makes sense and what doesn't, right? And I'm going to construct a portfolio for me and my family based on that, like that deeper level of thinking. I don't think there's anything else I wanted to cover in this video. Yeah, that's it. As usual, comments, questions, random thoughts below in the comment section. That's it for this video. Let's keep going. I'll see you in the next one.